Your mortgage rate, your credit card interest, your 401k, your job, the price of Bitcoin. Every single one of those is being shaped right now by a market most people have never researched, a market worth over $51 trillion in the US alone, nearly 3 times the entire stock market. It is not stocks, it is not crypto, it is bonds. And if you don't understand how this market works, you don't understand how money actually moves, or why your financial life looks the way it does. A bond is a loan, with you on the lending side. When a government or company needs money, they come to you, and millions of people like you directly, by selling bonds on the open market. You hand over your money, they promise to pay it back with interest on a fixed schedule. The principal is what you lent. The coupon is the interest rate you were promised. The maturity is when you get your principal back. And the yield is what you are actually earning right now, which is not the same as the coupon because bond prices move every single day, and yield moves opposite to price. Price goes up, your yield goes down. Price goes down, your yield goes up. That single inverse relationship is the key to understanding everything else in this video. Why does this market exist? Because governments spend more than they collect in taxes almost every year. The U.S. national debt now sits at $36.7 trillion. To cover that, the Treasury auctions bonds weekly and monthly to banks, pension funds, foreign governments, and investors like you. The yield set at those auctions becomes the benchmark every other bond gets compared against. The interest on that debt already costs roughly $3 billion a day, drawn from the same pool that funds healthcare, defense, and everything else. Here is what almost nobody explains clearly: the yield curve. At any moment, there are Treasury bonds maturing in 1 month, 1 year, 10 years, and 30 years. In a healthy economy, longer-term bonds pay higher yields. Lenders demand more for locking money away longer. That is a normal curve. Sometimes the curve inverts. Short-term rates rise above long-term rates, meaning investors believe the near future is riskier than the distant one. An inverted yield curve has preceded every U.S. recession since 1950, typically by 6 to 18 months. The yield curve inverted in 2022. The bond market was showing you something that most stock market commentary was not. Your mortgage rate is priced almost entirely off the 10-year Treasury yield, not off whatever number the Federal Reserve announces at its press conferences. When Treasury yields rise, mortgages get more expensive within days, not months. Something else happens simultaneously. Investors holding stocks ask a rational question: why accept stock market risk when a guaranteed government bond pays nearly the same return? That gap between expected stock returns and bond yields is the equity risk premium. When it shrinks because yields rise, money moves out of stocks and into bonds. That is the precise mechanism behind nearly every "markets fall on rising yields" headline you've scrolled past without understanding why it hit your own 401k. Not all bonds carry the same risk, and this difference matters. Government bonds, treasuries, are as close to risk-free as any investment gets. Corporate bonds carry real default risk. Companies can go bankrupt. Investors demand higher yields from corporate bonds to compensate. The gap between what safe government bonds yield and what risky corporate bonds yield is the credit spread. In calm markets, it is narrow. When investors sense economic trouble ahead, the spread widens. They demand more compensation for risk. This widening spread is one of the most reliable early warning signals of economic deterioration, and it appears in the bond market before it shows up in stock prices or your newsfeed. In 2022, the bond market had the worst year in over a century. TLT, the long-term Treasury ETF, fell approximately 40%, worse than the S&P 500 dropped that same year. Investors who believed bonds were always safe haven got a brutal lesson. The Federal Reserve raised rates faster than at any point since the early 1980s, and because prices fall when yields rise, every existing bond dropped sharply. Long-duration bonds, those maturing decades into the future, fell hardest because they're most sensitive to rate changes. The lesson is not that bonds are bad, it is that bonds are safe is conditional. They are safe from default risk when issued by stable governments. They are not safe from interest rate risk when rates move fast. If you held a bond fund in 2022, your statement that December made that exact point. Then there's the compounding trap inside the debt structure itself. A large share of that $36.7 trillion sits in short-term Treasury bills, maturing in 6 to 18 months, which means the government constantly rolls that debt over, issuing new bonds to pay off old ones. Every rollover at a higher rate grows your collective interest bill. The $3 billion a day number is not the ceiling, it rises each cycle. And every dollar that goes to debt service is a dollar that cannot reach your roads, your hospitals, or your defense budget. So what does this mean for your own money? 4 instruments worth knowing. Treasury bills, 4 weeks to 1 year, currently pay yields competitive with high-yield savings accounts with state and local tax exemption that can meaningfully improve your after-tax return. I-bonds, inflation-linked savings bonds issued directly by the U.S. Treasury, are capped at $10,000 per person per year, with yields that adjust for inflation every 6 months. Types, inflation-protected securities, work similarly over longer horizons, adjusting principal values with the Consumer Price Index. And for broad bond exposure, low-cost ETFs like BND or AGG give you the entire U.S. investment-grade bond market in a single holding. The old 60-40 portfolio is not dead, but after 2022, anyone who still treats bonds as automatically safe without accounting for duration risk is operating on an outdated assumption. The bond market is not a background system. It is the price-setting mechanism for the cost of money itself, for your mortgage, your credit card, the discount rate corporations use to value their future profits, and the rate at which your government borrows to fund everything it does. Most people watch the stock market and call that the economy. The stock market is a scoreboard. The bond market is the engine room. You now understand how the engine works. Everything else in personal finance gets clearer from here. Follow the wealth logic.